Hello, Stephen Koukoulas, Economist in residence for Zagga, with the monthly update on the economy. Now, what have we got? We've just had the Reserve Bank holding interest rates steady. They didn't put them up as some people were fearing they might. Instead, they maintained their rhetoric of recent times, and that is not ruling anything in or out, which means that they're, like mere mortals, not sure whether the next move will be up or down in official interest rates. And they're going to be looking at the data. Now, they do acknowledge that inflation isn't falling as rapidly as they would like. They're still forecasting inflation to get to their target range over the medium term, but they would like it there to be earlier rather than later, and that's fine. But the reason why they're not hiking is fairly clear. The economy is slowing down. I think that's a critical issue when we're judging, the remainder of 2024. I was a bit more optimistic that the economy would bounce back later in 2024 with income tax cuts, with interest rate cuts, but with those rate cuts being pushed further into the future, it's only the income tax cuts that are likely to be much of a sort of stimulant, I suppose, to the household sector, which of course is where the weakness is. Now, in recent times, we've had confirmation that retail sales are going backwards. We've had a run of incredibly poor retail sales numbers, so that's feeding into sort of this overall position of bottom line GDP remaining well below trend. The unemployment rate, while it's very choppy month to month, it goes up and down and all over the place, but broadly speaking, it's trending higher. And there's no doubt that with things like job vacancies, the job advertisement series trending down, the unemployment rate will move higher. And indeed, the Reserve Bank is forecasting the unemployment rate to get somewhere around about 4.25%, 4.5% over the next year to 18 months, which is well above where we are at the moment at 3.8%. So that slowdown is occurring. Now, interestingly, and a little bit of a worry still, is the number of new building approvals. House building approvals is weak still. There was a little bit of a recovery in the March numbers. I think it was up 1.9% month on month, but that's from a very low base. And of course, those numbers are volatile too. Obviously, heavily reliant on whether there's a big apartment tower that's been approved in a particular month or not. But basically the numbers are still very weak, hovering near their lowest level in about a decade. And that feeds into this shortage of housing, which is still evident. The rental vacancy rates are incredibly low. House prices are still at worst flat in Melbourne, Hobart, Canberra, those sorts of cities. Strong, really strong in Perth, Adelaide, Brisbane in particular. Doing okay in Sydney still. So we've got this situation where the shortage of housing is going to be a constraint and feeding into higher house prices. But for the here and now, the economy is weak. The construction side of the economy is cooling off. We've also had, just by the way, I just want to put in, we've also had just the Victorian state budget. They're cutting a lot of infrastructure spending as they try to fix the state budget here, which is in a fair bit of trouble. So if you were hoping for some sort of offset from infrastructure, construction spending, picking up where the housing construction sector is weakening, you're not going to get it in Victoria. So weaker economy, higher unemployment, interest rates on hold, but I think that can change quite quickly, particularly if we see rate cuts occurring in Europe, New Zealand, Canada, the UK and the US. That'll happen in the next few months. We'll probably be not far behind. Thanks, all the very best.